Now, when we are in the starting of the year, right, 2024, you should have a clear clarification about the diversification, what you should be doing in your short term related stocks and in your long term related companies, right? Is a combination of short term and long term stocks, which means there are certain high quality companies where if the fundamental strength is good, it has a moat. What do you mean by moat? Moat means a competitive advantage for a company which can drive the business, which can drive the profits for a longer period of time. Those companies are said to have a moat as coined by Mr. Warren Buffett, right? So those companies where qualitatively they are good, fundamentally good, they have a moat, a competitive advantage in the business, and there is scalability, wherein even if there is more funding happening in the company or there are more funds the company is getting, it can expand from there, right? So those kind of a scalable businesses, we keep it in long term. And generally for long term stocks means we keep it for 3 years or even 5 years and above. Similarly, with the trend, or if there is a high traction happening in a specific sector, we keep stocks in short term. So that is a momentary investing or a swing trading, right? Which means depending upon the trend, depending upon the sector, depending upon more funds coming into a segment, we keep it under short term. And that horizon would be, can be couple of days, couple of weeks, or couple of months, right? Less than 1 year is something where we keep under short term. So now in our discussion, let's see what is the bifurcation or how we need to diversify our portfolio between short term and long term related stocks we will discuss. And even yes, in our earlier discussion, elaborated call on top 5 sectors for 2024, right? So depending upon the sectors and depending upon the stocks related, depending upon the qualitative aspects of the company, you can diversify your portfolio between the short term and long term, right? So someone who have not had that particular learning, the discussion is top 5 sectors in 2024. Okay, so now without any further ado, let me share my screen and let's start the learning related to diversification rules, right? And why we need to diversify and what is the proportion of short term and long term we will be learning today, right? So first of all, we will learn the key rules in diversification. We will learn about long term, how we should be keeping short term, and then we'll also cover about the Sensex movement to 70,000 levels, right? To 70,000 levels, what are the lessons learned? So first of all, when we discuss about the diversification rules, first aspect is an ideal portfolio, right, should be between 20 to 25 stocks. There are investors wherein in the name of diversification, they have like 50 companies, 80 companies, and few members like more than 100 companies, right? Sir, I'm just diversifying my portfolio. I'm just entering into different sectors, different stocks, but the purpose of diversification will be lost if you have a portfolio of more than 25 stocks or even 30 stocks like that. The purpose of diversification is lost. The ideal number is 23 stocks or anything between the range of 20 and 25 is an ideal portfolio. This is a combination of short term and long term stocks related. Right? This is a combination of long term and short term stocks. Second, if you have a zoo of stocks, yes, I term it as a zoo of stocks, it will be very difficult for you to follow them. It will be difficult for you to track them. And if you need to do any corrections, a portfolio of 50 stocks, 60 or 80 stocks, it will be very difficult for you, right? And in order to diversify, and not to lose the benefit of diversification, restrict your stocks between 20 to 25. And too many stocks just for the sake of diversification, the purpose of diversification is lost, and it will not be a easy task for you to modify. Even I'll be telling you one more thing. Sir, yes, I have a stock portfolio entirely around 25 companies, right? And because of some reason, there are few companies where they are not moving anywhere, right? So you have a chance wherein you can move out of that stock and enter into another stock where it is trending. Even the sector, overall sector is moving, right? That's called as a sectoral rotation. One sector which is not moving or has been stagnant for a very, very longer period, you move out of that stock and enter into a stronger stock, right? So it will be easier for you to take the call if you have a restriction in the number of stocks you hold. Now coming to long term, right? Sir, what is the ideal number for long-term related companies? And what do you mean by long-term related companies? Long-term stocks are those wherein you hold for more than 3 years or even 5 years, right? Anything more than 3 years, and yes, you will be observing or you will be analyzing the charts in TradingView in weekly and monthly charts, not under daily, for long term. And yes, it should be a mixture of sectors. There are few people, sir, yes, I have certain companies in my long term which are qualitatively good, but everything is concentrated towards banks. Everything is concentrated into technology as a technology sector, right? No, it should be a combination, so that at every point of time, irrespective of the stock market, there are sectors which will move. Even last year, we saw electrical wire, right, has been doing wonderfully well for the last 1.5 years. Defense, railways, right, has been doing well. So a mixture of sectors is always good to benefit. And yes, in the long term, you should be having around 10 to 15 stocks, right? 10 to 15 stocks. And now, for investors who are into short-term and long-term investments, and that's the ideal combination, right? You should be taking positions in short-term, and the profits which you are accumulating, you should move it into long-term related companies, right? So this is very interesting. I want every one of you to focus. See, if you are in the process of building wealth in stock market, you need not start big. I repeat, in order to build wealth in stock market, or in order to build a portfolio in equities, you need not start big. You can start with a smaller capital. You can start slow. Whatever profits you are making from the short term, right, or any kind of a profit bookings, move it into long-term companies, right? So your short-term profits, you move it into your long-term companies, and gradually you build a portfolio until and unless you are retired and you are only dependent on the profits you make from the stock market. You should redeem, or you should get out of it. You should bring it to your savings account. Else, the profits you make in short term, ensure you again plow back into long-term companies, right? As the companies move, and even a company, any long-term company, if it is growing just by 25% year on year, it need not be a 1x, 2x. It need not give 100% or 200% in a year, right? Even if a company is giving consistently 25% returns every year, right? In 3 years, your capital would be doubling, right? Your capital would be doubling. So yes, the intention is to take benefit of compounding. So instead of booking your profits, the profits which you make from short term, move it into long-term companies and let the money compound. Let the money become a wealthy portfolio over a period of time, right? Over a period of time. And that's how you build a portfolio. You need not start big, right? You need not start big. And this also implies, right? This also implies when you're taking a position, do not be overboarded, right? I've seen certain people, sir, I have a very high conviction on this company. There is some huge capital infusion for the next 5 years, next 10 years. And I know this is going to revolutionize the entire sector there. So that is why a specific stock, I have almost 30% of my overall portfolio invested into that company, 50%, and people go to the extent of 70-80% also into a single exposure. I'll tell you, even if you are working in the same domain, you have a lot of expertise, you have a lot of internal and external news, always there are things which are not in your control. If something goes bad, your entire portfolio will be distracted, and you should not be in the game wherein you are thrown away from that game, right? No, don't take positions or don't be in a scenario where you can't see yourself in the game at all, right? So yes, every position you take, even under long term, have a position sizing, which means yes, a 4%, a 5% of your overall portfolio, you can be in that stock. And maximum, sir, I have a very good conviction and it is continuously compounding, and I'm closely tracking it, maybe around 8 or max 10%. Do not be overboarded. It's fine. Sir, I had like 5% of my entire portfolio into a stock. It has given me 300% return in just 2 years. If I would have had a 50% in that position, it would have been wonderful. I would have created a lot of wealth. Now think alternatively. If at all you had 50% in that stock, and because of some reason the stock has crashed, it's a huge dent, and it'll take a lot of time for you to recover. So I always say, whenever you're expecting some return, always be ready. What is the loss you need to face with also, right? Then it is a equilibrium mind. Just don't look at the profits. You should take care of the risk factors in it as well. Okay, risk factors in it as well. Now, as you understood about the long term related, let's discuss about short term, right? Discuss about short term. And yes, in short term also we look at a mixture of sectors. Have investments into your banks, your power related, right? Your railways, fertilizer. It should be a mixture of sectors, and restrict it to around 10 stocks, right? So yes, wherever you get the probability of profit booking, you do the profit booking, and you find a better opportunity, you move into a better opportunity, right? You move into a better opportunity. So restrict the number of positions you have, and specifically for short term, right, where there is more volatility and there is a higher risk here, right? There is a higher risk here. So for all your short term investments or the swing trading or the momentum investing, ensure you start with a not significant amount, which means, right, I'll give you an example. Let's say, sir, I've identified X private limited company, right? Yeah, this is the stock I wanted to take a position because I see some sectoral move, trend is there, price action is good, volume is good. Your first position should be a small investment, which means a 0.5 to 1% of your overall portfolio. Sir, my portfolio size is 10 lakhs. So you just invest 10,000, which is 1% in the first investment. The benefit of it is, yes, you have just invested 1%, which is equal to 10,000, considering your portfolio is 1 lakh. And here you have invested, let's say you have invested at 200 rupees stock price. If the price is moving higher to, let's say, 205 or 210, yes, you can again bring in another 1% or a 0.5% or a 2%, it's fine, right? You can again bring in. Again, it is moving up to 210 or 215 levels, right? You bring another 2% here of your overall portfolio, like 20,000. So the benefit is, as the stock is building up strength, you can always add in tranches, right? So this is called as tranches investment. We don't take a huge exposure, we do in tranches. Now, contrarily, you have taken a position because of some impact. Maybe the US jobs data was not good, US inflation is increasing, or there is a geopolitical tension between Russia and Ukraine, right? There was a bombing, there was a sudden battle. So the global impact, which is not in your control, you cannot do anything about it because this is not in our hands. So in that scenario, yes, market with the global impact, we will also have an impact. Because of any reason, if the stock has tanked down, let's say to 190 rupees, right? As you have not taken a significant position, or you have just added a smaller proportion, you always have the flexibility to exit, right? You always have a flexibility to exit. So it is a win-win situation. When you are losing, right? Yeah, when you are losing, you lose less. When you are winning, which means the stock is growing, is going in your direction, in the upward direction, you win big, right? You win big. An intelligent or a smart investor, or someone who wanted to excel in stock market, if you just remember this rule, yes, my rule is always, when I am losing, I will lose less, I exit out of the positions as early as possible, and when I am winning, I win big. I add in tranches and I increase my position sizing, they will be successful. Instead of starting with a very heavy amount, always focus on initiating with a smaller percentage and gradually spike it up, or gradually move it up, right? Move it. So I hope everyone had a clarification, or had a very good understanding about the diversification rules, long term versus short terms stocks, how you need to keep it, right? Now, just an interesting fact which we'll be discussing now is, you see the entire Sensex movement to 70,000 levels, or even 71,500 levels as on date, was very interesting, right? The first 35,000 levels of Sensex to touch, it took almost 35 years to achieve that. And yes, the remaining 35,000, it took 3 months, 3 years, right? 36 months. The first 35,000 movement of Sensex around 23 years. The remaining 35,000, it took just 3 years. And the interesting fact is, right, the numbers are this is the projection, but the perception can differ, right? Perception can differ. If you observe, yes, for the first 35,000, this is a 325x, right? So someone who have just started at the base of around 100, it's a 325 times compounding, right? It's a 325 times appreciation who has had. This is the benefit of compounding. Whereas, even though you see this 35,000 has just come in 3 years, last 35,000, which took 36 months or 3 years, it's a 2x on your investment, right? It's just a 2x. And now, in the last 3 years, even though the stock market, Sensex, has given a 2x return, there are many companies which has given much beyond that, right? Much beyond that. And some of the key pointers are, whoever are in the market rather than timing the market will be able to get these returns, or will be able to bag these kind of profits. Someone who have been very successful in stock market, or who have built a super profitable portfolio and have made their wealth in stock market, is because they have spent more time in the market than timing the market, right? Than timing the market. And the game is all about find good quality companies in early stage, stay invested in them for a longer term, and keep increasing your position at every point of opportunity, right? Every point of opportunity. And that's why I said, even you're a short term or a swing trader or a momentum investor or intraday trader, the profits you make, you should move it into the long-term companies rather than just booking the profits until and unless you are dependent on the profit for your daily household needs. If you have, sir, I have some savings or I have some pension coming, even for the retired people, you have to be in the market and always accumulate or have your investments into the longer term, right? Into the longer term, so that that's where the real wealth is built, or the real compounding, the magic of compounding works, right? And in the last 3 years, Sensex has given 2x returns, but there have been companies or there have been sectors where they gave multifold returns. The game is all about being in the market and having a long-term thinking, right? Sir, I will be in the stock market for a 1 year or a 6 months or a 2 years, and later on, when the market is at a peak, I'll be booking my entire profits. I'll stay on cash. I'll wait for another 6 months or 1 year, and then again I will start my investing. That's wrong, right? Because you miss 1 day or few days the bull run, there'll be a huge difference in the portfolio, right? So that's why don't time the market, time entry and exit into stocks, right? Entry and exit into stocks, right? Time in the market is more important than timing the market, right? Good. So I hope everyone loved this discussion, and what you can do, let me know below what are the rules or the diversification rules which you will be following from today. Let me know below, and if you have loved this discussion, type below as love.